What I'm really looking for, Michelle, and I really will kind of shut up and back off if we don't see this year, I am looking for a next wave down in stocks to gain some momentum, and it gains enough momentum once we hit a new low. And the magic number is 10,088 in the Nasdaq. If we break down through that, then we're in another big wave down. And I think that wave's going to have more momentum than the first. You go a lot lower. And then we see what investors think. Then we see if people don't start panicking, slow down on their spending and house buying, and get scared of owning stock.
Popular economist and founder of HS Dent, Harry Dent, is widely known for his gloomy predictions about the US economy and the entire financial system. Dent has been predicting a once-in-a-lifetime crash for the US stock market for years, but after the unprecedented money printing of 2020, his predictions have become even more gloomy, dire, and urgent. In April 2023, Dent warned that the biggest crash in our lifetime will likely happen by mid-June. During an interview with David Lin, Dent gloomily said, "We won't see this again. We will not see a bubble economy. Our kids will probably not even see a bubble economy decades and decades from now. It happens once in a lifetime at most." Dent noted that this huge crash should have happened in 2008, but about a year and a half into the crash, central banks just stepped in and started printing money at unprecedented rates. He added that since the crash wasn't allowed to happen then, another crash has to happen now to flush out the greatest debt bubble in history. During the interview, Dent said he believed the crash would cause an 86% decline in the S&P 500 and a 92% drop in the Nasdaq. However, that crash did not happen last year, to the befuddlement of Dent and every other financial analyst who predicted that the Fed's unprecedented rate hikes would crash the markets. Not to be dissuaded, Dent has more predictions for 2024. This time, he is very positive about his predictions. In fact, he has pledged to stop making predictions altogether if the crash does not begin in the later part of the year. According to the popular economist, our highly inflationary monetary policies, especially the multiple rounds of money printing and the Fed's habit of always coming to the market's rescue, have created a huge bubble, and there has to be a bust to keep the balance. We will now bring you clips from Harry's recent interview with Kitco News. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
The simple thing going on here, central bankers are determined to never have a recession again. They see recessions as a bad thing, which tells me, as somebody who's been involved with the highest levels of Fortune 100 company strategies and many, many new ventures and small businesses on the innovative end, failure is the secret to the free market capitalism. Yes, you have to have the freedom to innovate, new companies to grow, and not be over-controlled and all this sort of stuff. But you also have to let failures get cleared out. Okay, and that's what they're not doing. When 2008 hit, and by the way, Michelle, I predicted that decades before it happened. Late 2007 was due to be the peak of the entire baby boom, massive spending wave as they got older into their peak spending from 1982 to 2007. And when that hit in 2008 and early 2009, and they saw how bad the economy got, they just panicked and started printing money, and they thought, oh my gosh, $1 trillion ought to get this economy back jolting and going. Well, it didn't. And now they've printed $8 trillion many, many years later, 14, 15 years of stimulus. I actually count $27.2 trillion, 9 trillion money printing, 18 trillion, basically deficits by the government. I mean, and you don't usually run deficits every year, especially in boom time. So they have fought a downturn with stimulus that nobody would have dreamed of. I admit, no, I didn't see 27 trillion in stimulus to stop this train. And on the other hand, anybody with the least bit of common sense would say, if you keep taking the easy way out and just printing money and just having the government spend more than they take in and worrying about the rising debts, and now we have the highest debt ratios, public and private, and the private is 3 times the public. I'm not even worried about the government and them defaulting. I'm worried about the private debt, which is 3 times the government debt. So this is something that has to come back into balance at some point. I and anybody else has died a million times trying to predict this because they are, I mean, here's the thing. Once you start playing this game and keep stimulating, I mean, here's my thing. Here's where I'd give the Fed the greatest criticism. They had a chance in COVID to let the economy take a break for a good reason. Nobody would say there's something wrong with the Fed or the economy if we have a minor recession or something because of COVID, because people can't go out and spend money and can't congregate and socialize and all these things. But no, they doubled down. And $10 trillion of deficits in 2.5 years, $10 trillion, the biggest stimulus ever. And that's why we're still going. That if you have stimulus like this, you have to lag it forward a year to year and a half. So this stimulus is just starting to peak and wear off. And now, because they went so far in loosening, they finally did. And this was the mistake, going so far with overreacting with stimulus to COVID that they created 9% inflation literally overnight, okay? And then they had to go and tighten 525 basis points, and they may still have to throw in another quarter. That's the biggest tightening since the early 80s, which led to the biggest recession back then since the Great Depression. And I think you have to say, you can't say this hasn't hit. It's going to take to the end of next year before we see, end of this year, 2024, before we see how much it hits. But yes, am I humbled? Yes. I mean, have they been able to keep this ridiculous overstimulated economy going? But is that good? Is it good if somebody keep taking crack to get high or they say, what's the problem when you have a hangover drinking? Drink more. That's what we've been doing, basically. And I call that bad policy, and there will be consequences. And if there is not in the next year and a half, I'm probably just going to quit my profession,
When asked why the crash did not happen last year, Dent clarified that the reason was due to central banks declaring war on recession. He opined that central banks, especially the Federal Reserve, have declared a literal war on recession and continue to refuse to allow the economy to fall. However, Dent noted that we can only delay the inevitable, not completely stop it. Even with the unprecedented money printing, Dent is certain that we will keep falling back into recession. However, the economy underneath is really, really weak and really needs to get rid of a lot of bad debt and zombie companies. During the interview with Kitco, Dent also gave his predictions for 2024, including his outlook on gold. Let's get back to the interview.
The economy suddenly starts to slow for no obvious reasons. Consumers have spent and keep borrowing and keep getting a new loan to improve their house, all that stuff, until there's nothing to improve and their kids have left and they don't even need the damn house they have, okay? That's a lot of people are in that mode, okay? So spending, the economy has to weaken and respond to this tightening. And I'm expecting, the only difference, anybody would expect this tightening to have some effect. I'm saying since they put off this tightening so long, and then when they finally tighten, they tighten hard, I'm expecting, they're thinking the economy can take it and it won't be a big deal. I think the economy can't take it. That's the difference. And if it does take it and there's no big deal by the end of this year, then I'm probably going to be out of the forecasting business. If financial markets collapse like they have in times after, and only after bubbles, every bubble in history has burst, period, 100%, no exceptions, especially of this magnitude. These things burst the fastest and caused the greatest, but the Great Depression, was not that big. It was 25% unemployment and an 89% stock crash simply from a stock bubble peaking and bursting. There wasn't even that big a real estate bubble because people couldn't get real estate loans like they can today. Real estate didn't bubble up like stock. Just a stock crash caused 89% unemployment when it finally hit, okay? And a decade of depression off and on. There is consequences to this. And again, if there isn't in the next year or two, I'll just quit and say, I don't know anything about anything. I've studied history, and if anybody studied more than me, I will kiss their you-know-what in public, okay?
What do you see in terms of a downturn percentage-wise for the S&P, for the Dow, for the Nasdaq? Give me the specifics of your forecast.
First wave took us down 38% in the Nasdaq, 28% in the S&P 500, okay? Now we've had this bounce back to new highs and a few, but look, here's a classic thing for stock analysts. When you only see the generals make new highs and all the troops don't, that's called a huge divergence and a sign you're going to see another downturn. So the next wave, if I'm correct, the next wave would have to go lower than the first wave and from near highs in some indexes, not in the small caps and stuff. And that would end up having the stock markets, let's say by the end of 2024, down 50 to 60% instead of the 38 and 28, okay? So that would be the sign, okay, yeah, no, they weren't able to prevent this crisis. The stock markets are reasserting themselves saying, hey, something's rotten in Denmark. That would be the middle wave down, and every major crash in history has had 3 waves down, and the last wave would follow that. But most of the damage should be done in this next wave, and it should happen this year. Otherwise, we really do have a bubble and a non-burst for the first time in history. And I don't think anybody knows what to make of that, because that is never, ever, ever, ever. Gold is also, again, this whole timeline is getting stretched because they're able to keep pushing this crash out. The whole thing is don't let Humpty Dumpty fall off the wall because he's going to crack and break. Okay, that's the whole Federal Reserve thing. They pumped up a big bubble. They didn't intend to. They were just trying to save us from the last bubble crash. Now they got this huge bubble and they can't let anything fall apart. Okay, so that's the whole game here. They're keeping this thing together. Gold in the 2008 downturn and crash, which to me, I'm telling my subscribers, okay, that this next downturn is just 2008 recession, Great Recession times 1.5. 50% greater stock crash, 50% greater unemployment, all of that. It's just what the crisis needs to be to finish off and detox this whole greatest bubble in all of history, okay? So in that scenario, in 2008, gold held up in the early stages of 2008 and only crashed in the second 2 quarters, and then it crashed about 45% briefly and then went back up again. So gold was not the worst crash back then, but it did crash and went running to mommy when everything else. It was the last thing to crash, and I would see that happening here, that it's going to go up to 2022, maybe 2,300, not a lot higher here. But if everything else crashes later in the next year or two, what I'm saying to substantial new lows, gold will follow.
An 86% crash in the S&P 500 will take the stock index's prices below 1,000, which will be its lowest price since February 2009. That would be the mother of all crashes, and it won't just plunge the markets and the US economy into dangerous territories. It may very well take down the entire global economy, which experts believe will be very great for gold. So even if gold prices drop as Dent predicts, the price declines will be short-lived. Factors like quantitative easing, a weaker dollar, global monetary system collapse, and others do not just support increasing gold and silver prices, they do so over the very long term. Please share your thoughts on Harry's predictions for gold and silver prices in the comments section below, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on gold, silver, and other metals and commodities. Thanks for watching.